A generational wealth building opportunity is setting up perfectly in the stock market right now, but the craziest part about it is that no one even realizes that it's even happening. And I will say this, the window to capitalize on this is closing very, very fast, so let's dive in right now. And this information is so important that I even typed the whole thing up for you guys right here, so let's go through it. We're going to go through the Fear Greed Index first, because this is hands down critical to understand if you really want to understand where this lifetime opportunity in the market is. Let's break it down. So, current read on the Fear Greed Index is 64, and a week ago it was 71. You're probably wondering, like, why do I even care? That's not really a big deal. Here is the big deal about it. We have to go down and look at this other chart of it. You can see going off the April lows, the Fear Greed Index was at a level of roughly 4. Now it's all the way back up at 64. So we are slightly into the greed category right now. You're probably going to say, well, Brandon, you talk about all the time to be greedy when other people are fearful and be fearful when other people are greedy. So right now people are greedy. So isn't that a time to be potentially fearful and think that the stock market is potentially overvalued and potentially buy puts and sell calls? Well, maybe. So the Fear Greed Index, we're just going to throw it out the window right now because it doesn't even matter right now for how big this is actually going to be. So we're going to go through 4 things right now. Number 1, 2, and 3 are going to prep you for number 4, which number 4 is the whale in the room. So let's start on number 1, which is critical to understand. We all see the headlines of the 30-year bond yields going way up, the 10-year bond yields going way up, the Japan bond yields going up, all this stuff with bonds, it's freaking a lot of investors out. And I understand it because interest rates are like gravity on the market and bond yields are like gravity on the stock market too. So as, the 30-year mortgage goes up and as a 10-year bond goes up and as a 2-year bond yield goes up, as all those yields go up, more people are becoming bearish about the stock market. So what are they doing? A lot of them are selling their stocks and then go buying a 10-year bond and getting this guaranteed 4.5%. And I get it. And if you think that the bond yield is going to keep going up, yes, it's really bad for the stock market, but I do have a lot of conviction that I expect interest rates to fall in the coming quarters because inflation is going to continue to fall. And when inflation continues to fall, the Federal Reserve is going to then go lower interest rates. When they lower interest rates, it's good for the stock market. Stocks usually rip a lot higher. So that's just going to add jet fuel to what I feel like is coming right now with this massive wave to capitalize on it. So right now is a good time to get in because there's still a little bit of bearish sentiment around interest rates. And once that gets priced out of the market's probably going to rocket higher. So that just shows you the perspective of signal to noise. The noise is what everyone's freaking out about yields going up. The signal is that yields are probably going to go down as time goes on, which is actually great for the stock market. Now, something that is actually signal and noise in a market, so we're going to separate it to understand what matters of this aspect and what doesn't, is market valuations. So right now, the S&P 500 is trading at a valuation level not seen since the dot-com crash. And you're like, holy crap, Brandon, a dot-com crash, we're in that same valuation level right now. The answer is yes, but there's 2 critical differences between right now and the dot-com crash. The key difference is that the businesses are actually making a crap ton of money right now, and their earnings are rocketing going into the future. So yes, the valuation level is a little bit rich right now, but going into the future, they're going to look cheap looking backwards because the earnings and the profits of these companies are going to go way up. So a couple years down the road, you're probably going to wish that you got into the market at the level that we're at right now because things are going to be way more expensive going into the future. And remember, the generational wealth building opportunity, it matters for this because if you don't think that this is actually going to play out how I think it's going to play out, you probably will lose money. But I am very, very confident that this sector of the economy and this sector of the market is going to absolutely rocket because the growth is going to be astronomical for that sector. So yes, the valuation level, of course, is going to be a little bit lofty because it's trying to price in how much growth is actually going to happen. And I know I talk about this chart a lot on this channel, but we just got a very important update. And as I said, whenever we get an update, we're going to talk about it so that we know if we should get into the market or not, or maybe wait for a dip. So the darker line corresponds to the earnings per share of the S&P 500, and the lighter line is the S&P 500. So typically the S&P and the earnings on a percentage basis move the same in a 10-year time period. So this is a 10-year chart right here. It started at a similar level right here, but you can see the market's a little bit higher than what the actual earnings are right here. So based on this, the market does appear to be a little bit expensive. But the growth that we're expected to get going forward, and I do agree with the growth expectations, it's going to be massive. And this darker line right here, which is the S&P 500 earnings per share, I do expect these earnings per share to rocket higher because these companies are going to be much more productive, much more capable, much more efficient, make more money. Overall, the earnings per share is going to go way up. And when earnings per share goes way up, it'll justify the stock market valuation right now. Now keep in mind, this is only for the S&P 500. There's individual companies within the S&P 500 that are very, very cheap right now. We're going to get into a couple of them. So they're very cheap, they're growing like crazy, and it's a great time to get invested in those right now before the window closes, before they rocket and take the next leg higher. So there's four critical things that we're going to talk about. We covered market valuations and how it is a factor, but for specific companies within the S&P 500, they are very, very cheap, and we're going to capitalize on that. We talked about interest rates already, so that's two of the four. Now we're going to talk about Trump, and then we're going to talk about the thing right below Trump that is a massive, massive needle mover for the market. And this is essentially what's going to make the market go way higher and where you should deploy your capital right now. So Trump absolutely loves a post on his Truth Social account, his X account, and he talks about whatever is on his mind. And he often posts major catalysts for the market, and that creates a lot of volatility, both upside and downside volatility. So at a time that valuations are questionable and interest rates are questionable too, Trump's negative tweets often push the market lower. So the reason why I'm saying this is because you're like, Brandon, this is negative for the market. Trump's going to make the market go down even more. And maybe he will. But the critical thing to understand is this. When he sends out a negative tweet and we get something about a trade war or whatever he's talking about that's negative for the market, that is a time to deploy even more capital in this thing that I'm about to explain to you right now, because that is just getting it on sale before the massive leg higher comes. I see it time and time again when the market goes down, people just freak out and want to sell all their stocks. But then when the market's going up, it's like, take my money, I can't get enough of it. You don't want to think like the herd. You don't want to think like the typical retail investor, because most investors lose money. So when the market's going up like crazy, that is a time to be cautious and maybe not buy as much. But when the market dips, which it will dip again because Trump loves volatility in the markets, that is a time to deploy even more capital in this sector that I'm going to explain to you in just a second to capitalize on discounted prices. Remember, we like discounted prices. Whenever you see a sale at the car dealership or at the store or something that you want to buy, whatever, you want to buy when things are on sale. But when things are going up in price, it's like, hey, today things are 20% more expensive. Do you want to buy? Nobody on earth wants to go buy gas when it's 20% higher. But if they say we're doing a 20% sale on gasoline today, sure, let's go fill up our tanks. So that's what you need to think about when you're an investor, because it is going to be bumpy. It's going to be very volatile. But if you're patient and you hold in there for the long run, you're probably going to make a lot of money doing it. And drum roll, please. It's the fourth industrial revolution that's happening right now, that if you deploy your capital in the right way, not just go buy NVIDIA shares, not just go buy AMD shares, not just go buy the QQQ NASDAQ index. If you deploy your capital how I'm going to teach you right now, you will capitalize and understand when you're buying at a good time and at a bad time, and know how long you have to keep your money invested for to reap the rewards, and understand if you should do options or not to capitalize. So, in my opinion, the fourth industrial revolution is starting right now, and it's going to be massive. Tech and AI is now on the next level, and it's only going to get better. I'm talking about humanoid robots. I'm talking about self-driving cars. I'm talking about AI agents, which is essentially just an AI employee that could do many of the jobs that regular people could do. It's going to save companies a lot of money, and this is just the beginning. And I have a 3-month-old, and I think about this all day long. It's like the world is going to be so different for him growing up versus me. I mean, we all remember our flip phones when we had the BlackBerry and all that stuff. Like, BlackBerry is going to be the best phone forever. And then iPhone came along, and BlackBerry is like, what BlackBerry? So there's going to be things that come along where it's going to be like, what iPhone in the future? And it's going to be groundbreaking, and those companies are going to make a crap ton of money. And I think about this all day long, 24/7, of like what companies are going to be the winners and what ones are going to be the losers, because I want to capitalize on this massive opportunity. So my current portfolio allocation right now is big tech ETFs like QQQ and SOX, which is a semiconductor index, and QQQ is the NASDAQ. But stocks like Tesla, AMD, NVIDIA, Meta, and Amazon, plus a few others, are some of the key companies, in my opinion, that are going to capitalize on this massive tech and AI revolution happening right now. But before you click off this video, it's not that simple, and I have to tell you what to do with stock options to capitalize the right way, because options are a great way to generate monthly cash flow and income by selling options and just doing options in general. I've been doing this for years, and it works very, very well. So the key for the fourth industrial revolution is this. You have to capitalize. Don't sit on the sidelines. Don't let this opportunity pass you by. Some companies are bubbles right now for sure, like Palantir. I think Palantir is very, very expensive, but that doesn't mean it's going to crash. It just means that the future returns going forward for Palantir are kind of like priced into the stock right now at $130 per share. So I don't think Palantir is going to make this massive, exponential return in the next couple of years, which is what it did in the last couple of years. So you have to be very careful with companies like that. I'm not bashing on Palantir, by the way. I'm just saying that people made a lot of money on it, and you should consider deploying your capital in companies that are a little bit more undervalued than that one to capitalize on the next leg higher. So I feel like the next 5 years are going to be truly transformative. And if you capitalize how I say I'm going to capitalize right now, you're going to do well. And that's where we go into the okay, let's put it together section right here. Valuations are a little high, bad. Interest rates a little bit high, bad. Volatility is a little bit high, which is actually good because we could capitalize on the downside and upside volatility. When we get downside volatility, we could buy calls, we could buy shares, or we could sell put options. When we get upside volatility, we could buy puts, we could sell calls, or we could just short the market if we want to, because we're just capitalizing on these big moves going up and down. And when the market gets stretched to the upside, we do bearish plays. And when the market gets stretched to the downside, we do bullish plays. It's very simple. So as valuations get a little bit lofty, I start to reduce a little bit of risk in my portfolio. And when valuations get cheaper, I start to add risk in my portfolio. And as I've always said, invest in the base portfolio as long as we are not in a bubble valuation territory, which we're not right now. Now, the companies that I listed above, I love them. And those companies are all trading near intrinsic value with a moat, with pricing power, with a durable competitive advantage. And I'm okay to hold them for a few years. I'm not doing short duration plays on these companies and holding them for like 2 months. There's going to be a lot of volatility if you try to time the market perfectly. You're going to say, I'm going to go all in on AMD, and maybe you'll do well, but there's going to be a lot of upside and downside volatility. So if you extend your time horizon a little bit, you will do very, very well. But doing short duration plays, you're probably going to get smoked on it. Now for options, we'll keep this very, very simple. Only do stock options when you have high margin of safety plays. Don't just make option trades to make option trades. The setup has to be just right. Because if you don't understand if the stock is going to go up or down or stay flat, you can't do option trades based on that, because options are just a leverage way to capitalize on an expected move. If you think a stock's going to go up, you buy call options. And if you think a stock is going to go down, you buy put options, or you could sell options on either side of that too. But if you don't have conviction in a direction that the stock's going to move, why are you going to go make like a leverage bet to try to predict what the stock's going to do? You don't want to do that. And mark my words, the market's going to be much, much higher in the years going forward. And if you get into these companies that are going to lay the foundation for the future, and you be patient and you hold them and you do stock options in a conservative way, you will win massively in the stock market. That's all I got to say. If you want to see more on my stock option strategy, watch this video right here. It's going to totally change your life. But if you don't want to do that, click the link below in the video description for my course and my Discord. It's 1 monthly subscription. It's going to blow your mind. I show you all my trade alerts in real time, plus way more in Discord. I'll see you guys there.